Special coverage from the Deutsche GOLDMESSE is brought to you by First Majestic Silver. There's no substitute for silver. Hello and welcome back to the Deutsche GOLDMESSE. Welcome to Frankfurt. Welcome back to Soar Financially. My name is Kai Hoffman. I'm the JR Mining guy over on X, and of course, your host of this channel. I'm also the host of the Deutsche GOLDMESSE, and it is my great pleasure to introduce John Forwood. John, you're the CIO over at Lowell Resource Funds. You're one of our keynote speakers here at this event. Thanks so much for joining us in Frankfurt.
Look, it's a pleasure, and I'm honoured to be invited, so thank you very much.
Really appreciate you coming all the way from Australia to share your wisdom, and you gave the morning keynote this morning. I think people were following quite closely, and let's dissect the markets a little bit, because that's your specialty as well. You're an investor too. Maybe let's start at the top. What's driving the gold and silver market these days?
Look, I really think that there's three main factors, but the most important one is the US Fed funds rate. And we see a very strong inverse correlation between the gold price and the Fed funds rate. So the outlook at the moment is for further rate cuts in the US, and that is positive for gold. Silver. Silver obviously has industrial fundamental demand, so the drivers for those two are quite different. Similarly with the other precious metals, the PGMs, which we haven't spoken too much about here, but PGMs have a lot of fundamental industrial demand as well. So you've got gold being driven by financial considerations, and you've got silver being driven both by financial considerations and by industrial demand. So very positive for silver.
Let's explore that Fed angle for just a second, because I'm wondering, why is that angle or that correlation so strong between the Fed and and gold right now? What is driving that? Why are people so focused on what the Fed is saying? Shouldn't that be completely irrelevant in theory?
Look, I think the fact that gold doesn't pay a yield means that if interest rates are high, then people can leave their money in the bank and earn 5, 6, 7% interest, no risk. But now that interest rates are below 4%, Fed funds rate, and the market is expecting that to go lower over the next 12 months. That's really positive for gold. So that's a big driver. The other drivers for gold, of course, are de-dollarization. We've seen non-Western central banks increasing their gold holdings significantly, and I think there's a long way to go in that. And also just liquidity. It is unusual to see the gold price hitting all-time highs, equity indices hitting all-time highs, other assets also hitting all-time highs. So I think liquidity is just a fundamental thing that's raising all boats at the moment.
It seems like almost like a rhetorical question, but we're here in Europe, and our interest rate is around 2%. Right? The Fed funds rate is around 4, 3.75.
Yep.
Here we're down to 2.15, I believe. Why is the Fed funds rate more important than maybe the European Central Bank lead rate? Why are we coming back to the same question? Like European investors, why would we care? Because we should all be buying gold, because we're not really yielding anything here with a ECB fund interest rate at 2%.
Yeah. Well, look, I guess the historically the US, it is the market that everyone follows. But yeah, you should be, if you're using euros to buy gold, you should be looking at the EUR Gold Price, obviously, rather than the US dollar gold price. So, look, the US, and we had a great discussion there yesterday on the panel about the reserve currency and, the alternatives to the US as a reserve currency. US is still the reserve currency and dominates financial markets. So that's by default. It's really interesting to me, looking at the junior resources and exploration sector, that that sector does not react in Australia anyway to the Australian dollar gold price. It reacts to the US dollar gold price. And you should think, no, well, why would that be? But yeah, that's the driver.
Yeah, it's the same in Canada. We all look at the US dollar gold price. That's the indicator, par none, or bar none, right? We all do that. There's a bit of a competition for resources going on. Not open secret here. It's like the war for oil, but seems like there's a secret war for commodities and resources, rare earths in particular. How do you look at that, and how do you factor that into your investment decisions?
I think that is very important for critical minerals and critical metals. That's one of the fundamental drivers. You always worry, of course, when governments get involved in private enterprise. Their role is not to pick the winners. They should be setting the regulatory environment. But that, in general, has been positive for the market to see the US government in particular get involved in funding rare earth projects, get involved in funding nuclear reactor build-outs, for example, which has been in turn positive for the gold price. So I think in terms of critical minerals and critical metals, the fundamental drivers, there's the reshoring aspect, but there's also then just the pure demand. And probably the best exemplification of that is the demand from AI data centers. And everyone probably have it's hard to have a view on, how much that's going to increase the demand for electricity and in turn the demand for things like copper in particular, electrification, but also energy. But it's got to be positive. There's no. I don't think it's going to decrease the demand for any of those minerals, and it potentially could increase the demand massively.
What are your thoughts in general? Let's theorize a little bit on governments getting involved in general. Like, what are your thoughts? Should the U.S. government, or any government for that matter, get involved in the resource security business, meaning or investing, taking stakes in companies like the U.S. has taken 10% stake, I believe, in Trilogy, MP Materials, just to name a couple.
Yes.
Should they do it? And what are your thoughts on that?
Look, I think it's fraught with danger, and often, it does end in tears. But because of this competition between East and West, the Chinese are, by hook or by crook, supporting their critical minerals industry and picking winners and encouraging investment in certain sectors, such as copper refining, for example. So how is the West going to compete with that? Copper's a great example where the treatment charges for smelting have been driven to zero and often below because of the build out of Chinese smelting capacity. So that's sending the Western smelters broke, quite literally. Does the West roll over and say, oh, well, that's a private market enterprise thing, it's not our problem, we'll let you go broke? Or does it say, no, we're not going to let that same thing that's happened to rare earths happen to copper, for example, and we're going to support the industry? I think the latter is probably the way it's looking like going, but it's a very expensive exercise for governments. It's billions of dollars to keep these things operating.
Maybe to summarize, but you're all for it, the government stepping in?
Look, it's maybe it's a necessary evil, kind of.
No, fair enough. Yeah. No, and we're just playing catch up now.
Yeah.
So I think the government needs to step in there. Unfortunately, the free market didn't do its job.
Yeah, free market didn't do its job. Yeah.
Right. So absolutely. Let's talk about some of the trends in the junior resource market. Let's break that down. We just discussed on the macro. How are the mining stocks behaving? Like, who's performing well? Who's not performing well? Where's the money flowing to right now?
Look, I think precious metals have attracted a lot of attention, and they've done very well, particularly in the larger caps. But what we've noticed at the Lowell Resources Fund is there's been winners across the board. We've had good winners in oil and gas, with winners in tungsten, winners in manganese, for example. So the market is receptive to good results, good discoveries in a lot of different commodities at the moment. It's not just gold. Obviously, if you make a great gold discovery, it's going to go to the moon. But other commodities as well, the market is receptive to that. But I think that's in terms of commodities, but if you break down companies in terms of company size, and I think you've seen this in a lot of sectors, that the bigger companies have got bigger and the smaller companies have been maybe not left behind, but they're still finding it quite hard to raise money, particularly the absolute microcap or nanocap sector. So we're yet to see the full trickle-down effect, if you like, of money going in the top and then making its way down to float even the little boats as opposed to the big cruise liners. So I think that's a signal to me that we still might be in a fairly early stage of the market. And the other thing that I remember, back 20 years ago when we saw the first China boom, take off and everyone was piling into resources. Back then, there were companies that were trading at a PNAV or a premium to their underlying NPV of their project, in excess of the underlying NPV. We're nowhere near that today. Development or pre-development companies are generally trading at 10 or 15% of their underlying NPV. So potentially, there's still a long way to go just to be in those companies and see the market allow those companies to realise full value on their projects.
Maybe just to summarize, like where is the money right now? You mentioned it with your hands, you gestured it. So on the scale, like where are we? Where's the money right now? Like on a funnel, like where are we?
Yeah, look, I think there's some great data there from Oztex breaking the market down into quartiles in the ASX, and the top quartile is the plus $100 million odd market cap companies, and they've done the best over the last 12 months. The bottom quartile is the sub $10 million market cap companies, and they've really been left behind. So I think the money sort of trickled down into the sort of from the 100 million plus, and that includes BHP, for example, to the $50 to $100 million level, and it's starting to move down again. But yeah, it's still yet to get right to the bottom of the funnel.
Yeah. No, it's interesting because you're looking at your portfolio. You are in the grassroots space quite extensively, about 30% portfolio exposure, I believe.
Yep.
Why are you staying there? Why are you being so patient? Don't you have FOMO? Seeing like what's happening maybe in the producer or developer space.
For sure. And I think it's probably not FOMO. We probably have that boat has in some respect, like the producers have been re-rated pretty significantly, and they can be re-rated more, particularly if say the gold price goes up more. But we're sticking to our knitting. We think that real micro sector is where the next amount of money needs to go in, and it's also as research data has shown, that's a sector that makes the discoveries, and that's when you really have the potential for exponential returns.
Oh, absolutely. That's where you get the 10 baggers and some, usually.
Yes.
Forward-looking statement there, of course, but no, fantastic. Maybe break it down for us as well. Like, what kind of commodities are you interested in or looking at? And I remember gold, of course, is quite heavily weighted in your portfolio.
Yep.
What about the others?
Yeah, so gold is, in terms of precious metals, we're well over 50% exposure to precious metals, which is largely gold. But PGMs, platinum group metals, have very good fundamentals as well. We've got 1 to 1.5 investments in PGMs at the moment. With the other half is a copper nickel PGM project in Minnesota, which is a spectacular project, and also silver, of course. But it is much harder to find silver investment opportunities in Australia. The best place to hunt for those is obviously in Canada, with a lot of exposure to places like Mexico and Peru, the big silver producers. In beyond precious metals, our next largest investment by commodity is in the copper sector, and we're really looking at companies there which have great leverage to the copper price. Copper price hit all-time highs in London only a week or so ago, not nearly as high as the New York price got when tariffs everyone was worried about tariffs, but still the copper prices moved up from $4 a pound last year to sort of $5 a pound. But we think there's a long way to go. The forecast shortages are they're hard to ignore. They're hard to argue against.
And that's purely supply and demand forecast.
Yeah, exactly. Yeah, and obviously it never, like all the charts show. Okay, demand's going to be X and supply is going to be 70% of X. It never happens. Obviously the market meets.
It's always
itself.
like free beer tomorrow, though. And tomorrow never arrives.
Yeah, exactly. Yeah.
That's what the copper forecast. I'm bullish copper as well, but it feels like all the forecasts I'm seeing, like, of course, in 2030 we're going to have a massive supply deficit.
It's getting pushed out. Yes.
But every year, it's a year later. It's like free beer tomorrow. It's like the Fed with a 2% inflation target. Yeah, 2 years from now we'll reach that. But it's always 2 years from now.
Yes.
Right.
Yeah. But look, I think this year's been really interesting for copper supply. It's been, you always have production target misses from the big boys. But this year there's been a lot of problems in terms of production. Grasberg is probably the standout. Last year it was Cobre Panama, etc. And those problems are still very much with us. So it's very easy to say, okay, we're going to have X amount of new copper supply coming on, but it's actually very hard to create that new supply. And then demand, certainly out of China, is sort of inexorably growing. So copper, I think, in the midterm, maybe not so much in the short term, but the midterm is a good bet.
Noticing you're massively underweighted, of course, critical metals. Is that something you're looking to increase? Why are you such a small portion? Like, is that just because the action was in gold right now?
I think so, and so there's been re-rating of our gold holdings and not re-rating of perhaps some of the other things. But yeah, lithium, for example, has been very good to the fund. I would say we've had 3 lithium booms in the last 10 years, and that's really benefited the fund very well as our exposure to lithium. That's something we debate quite carefully. Is lithium ever going to come back? Is it not?
Any decision on that? Like, do you have an inkling where it might go?
We do have a couple of exposures to lithium, and I think the lithium market is volatile. A lot of markets are volatile, but lithium is still such a small market. That's very easy for it to swing from oversupply to undersupply and back again. And maybe we're just starting to see a little bit of that, undersupply creeping back into the market in the last couple of weeks. So, but yeah, we're certainly. It is harder to find good opportunities in those critical minerals, or those specialty metals, should I say. Tungsten, manganese, battery minerals, lithium, nickel. Nickel's another one that's really interesting. Yeah. That's I know there's some really bullish pundits, and one in particular might be here at the conference. That's something that is also historically one of the most volatile commodities, and it's something that we're looking at closely.
Fantastic. No, I appreciate that. You were a keynote speaker. You were just on stage for 30 minutes. What was something you wanted the investor to walk away with from your speech?
Look, I think that correlation, or very strong inverse correlation between the Fed funds rate and the junior resources market, that's probably, if people don't remember anything else, I think that's one of the key takeaways. So investing in junior resources, you really need to take a view on the Fed funds rate. And it was interesting listening to Alex Krainer yesterday. It was sort of a little bit similar. He said, the oil market is 80% driven by the value of the US dollar. And the value of the US dollar is obviously driven by things like the Fed funds rate, the economy, So it's sort of similar, and the other side of the coin to what Alex was saying yesterday.
No, it's interesting because we've noticed back in 2022, because we tracked the financings with Oren Inc., back in March 2022, financing window just completely closed. It was actually nailed shut.
Yes.
Right? The second the Fed started raising interest rates, the market completely fell apart. At least in North America. So Australia was a bit anti-cyclical there, but it was doing better. But for Canadian juniors, it was dead, for lack of a better term. Fantastic. John, really appreciate you being here in Frankfurt. It means a lot to us that you made it all the way from Australia. Thank you so much for coming out. Where can our investors find more of your work?
Well, we've got our website, LRFM, or lowellresourcesfundsmanagement.com.au. Please visit there. There's a wealth of information on there, and obviously we're listed on the ASX. So if you go to the ASX website, you can find all our releases.
Fantastic, John. Thank you so much for joining us. Much appreciated, and everybody else, thank you so much for tuning in here to Soar Financially from the floor of the Deutsche Goldmesse. Tremendously appreciate your support. Great meeting so many of you here in Frankfurt. Keep it up. It means a lot to us, and thanks so much. And leave a comment, leave a like, hit that subscribe button. Take care out there.